Welcome, chart watchers. It's Greg Schnell, and I am here to host Martin Pring with the monthly Market Roundup webinar for March 2019. Thank you for taking the time to listen in today. We do this special event once a month, and Martin always has great charts for us, and I'm really looking forward to what we've got. Martin, how are you today?
I'm terrific, Greg. How are you? Thank you.
I am doing really, really well. The market is making me work very hard on my charts these days. I'm trying to figure out which way the currencies want to go, which way the commodities want to go. The equities seem to go up. What's your take on things?
I'm with you. I'm confused.
There's a lot to look at. That's for sure.
As you know, in technical analysis, we deal with probabilities. And when you got half the indicators bullish and half the indicators bearish on commodities and bonds and stocks and things, it makes it kind of interesting to kind of figure out where we're going. So what we need to do, I think, is kind of look at some charts that may guide us in the right direction when things begin to break in one direction or the other.
Agreed. Well, let's start rolling through them. You've got lots of charts, so let's cover them off.
Yeah, we have quite a few. Let's get going. So the areas I'm going to be covering today are, first of all, I've got a reliable rate of change indicator, and that's gone bullish for US equities, and we can take this indicator back to the 1950s, and it's been pretty consistently accurate. But by the same token, as I keep mentioning about the probabilities being fairly evenly matched, we've got some rate of change trendline analysis looking at different rates of change, which argue more in a bearish direction. But then we've got a 45-day rate of change, which is super bullish. So you can, if you want to be bullish, you can be bullish by looking at some of these indicators. If you want to be bearish, you can be bearish. But the fact is the evidence is fairly evenly matched. And we want to be careful what we do in either direction. So the same thing is true in the commodity markets as I see it. We're in a very finely balanced long-term technical position. We'll take a look at that. We'll also take a look at the Canadian and Aussie dollars for some possible clues as to which way that these commodities are going to break, to the upside or the downside, because these are, of course, very resource-based, resource-sensitive currencies. And another thing that's happened in the last month, which is actually putting the probabilities in favor of a bull market, are occurring in Shanghai, where the Shanghai Composite is broken back, it broke below its secular uptrend line going back to 2005 last year, and with this month's or February's close, it's now back above that trend line. And there's some also interesting breadth data we'll look at, which suggests that Shanghai is going higher after it's underperformed the US for the last year or so. And then finally, when we look at the economy, we find that some of the leading economic indicators are close to a recession call. They're not at recession yet, but they're at the point where we want to see the economy begin to improve. Otherwise, it may this indicator or these indicators may start to slip some more and sort of be indicative of a recession down the road. So let's take a look at that ROC indicator I talked about before. On the top panel, we've got the S&P, and underneath is a 12-month rate of change. And what this model does is it says when the S&P drops below 5%, or I should say when the rate of change drops below 5%, in other words, that blue horizontal line there, that sets up the first condition of the model, and that puts it in a bearish mode. But when the rate of change comes back and crosses above zero, that means it goes positive, and that gives us a buy signal. And in this case, we get a green arrow. We also see the same thing happening in 2016, where it dropped below its minus 5% level, and then rallied back above zero, give us another buy signal. Well, guess what's happened in the last few months? We dropped below the 5%. We've rallied back above zero, sharply back above zero to a fairly high level in February, and that gives us another buy signal. So that's just going back for, 10 years. And as you know, Greg, I like to go back a lot further than 10 years in my research because these could be quirks. So let's take a look at the longer term chart. We're looking at the same approach here. We're looking at the 12-month rate of change in the bottom panel, and the S&P composite in the upper panel. And the green vertical lines tell us when we've broken below the 5% level and crossed back above zero. You can see here in 2001, it tried to get above zero, but couldn't do so and didn't give us a buy signal. But now we got another buy signal here. And so all these vertical green lines show us going back all of the signals that have taken place since 1957 or 1955. And in 57, there was a false signal. So we've had one false signal, but countless other signals where we've had tremendous rallies following these signals. So that I regard as a pretty positive sign. The one thing that causes me a little bit of problem is that in 1957, you can see the indicator went bearish during this initial drop, and then it rallied for the first bear market rally, not unlike what we've just seen, where we fell below the minus 5% level and we rallied up again. So we may see a repeat of 1957. So what would obviate that, obviously, is if the market can rally in March, which is going to be kind of a difficult thing to do because it is pretty overbought on a short-term basis, or it could consolidate in March and not go below the 5% level as it did in 57, and that would kind of put it in a much more bullish light. So what I guess I'm getting down to is I think really we're going to find March is going to provide us with some very significant signals, either on the upside or the downside. So we need to watch what's going on fairly closely in that month. So I mentioned also that rate of change currently is also giving us some bearish signals. And this arises from a technical principle that says price at any one time is determined by the interaction of a number of different time cycles. And when we look at a rate of change, we're only looking at a specific time cycle that's reflected by that particular time span. So what we need to do is to look at several different time spans, because when they're all in agreement, then the principle of commonality says we get stronger moves, either on the upside or the downside, depending on which way these cycles are operating. So what I got on this chart here are three different rates of change: a 9-month, a 12-month, and an 18-month, and they're all reflecting different cycles. So you can see that occasionally on major turning points, what we see is everything is moving in the same direction. So we look at the 2007 top, and you can see that all three rates of change violate trend lines, and the price itself also violates a trend line and signals a bear market. Then if we go back to the 1990s, you see the same thing happen, where you're able to construct three trend lines for the rates of change, and when they were violated, we saw a bear market follow. Then we can look at the current situation, where again it's possible to draw four trend lines, one for the S&P and three for the rates of change. And at the present time, even with the recovery rally we've seen, you can see we're still below those trend lines. So again, it goes back to March. What's going to happen in March? We're going to see a strong extension to the rally, in which case this negative combination here would be obviated. Or are we going to see things come down and test the low, in which case that's going to kind of confirm what's going on with these rates of change? So it's a very complex situation that's going on right now. One of the other things that concerns me is the long-term psychology of the market. And that's when I look at something like the Shiller price earnings ratio, which we can take all the way back to the 1870s. To me, although it's a valuation measure, to me it's more like a psychological measure, because when it's at a high level, what it means is, in this case here in 2000, that investors are willing to pay $45 or so for $1 worth of earnings. And that indicates that they're very optimistic, because if they weren't so optimistic, why would they pay such a high price, $45 or so for $1 worth of earnings? And yet at the low down here in 1982, people are willing to throw away stocks where they can purchase them for excuse me, $6 to $7 they're paying for $1 worth of earnings. So to me, this Shiller price earnings ratio indicates these very long-term swings in psychology. And psychology has two aspects to it as far as I'm concerned. One is the degree of bullishness or bearishness. That indicates opportunity, or if it's a very high level, it indicates vulnerability. And the second thing is that's fine, because you can go on and reach significant new levels of high levels of confidence as reflected in the price earnings ratio. It's kind of like an elastic band. When it's stretched, you can stretch it even further. You never know exactly when it's going to break. Well, the same thing I think is true of these valuation measures or psychological measures of the stock market. It's possible to get the elastic and stretch it even further. So what we've seen since 2009 is a kind of a zigzag up, because every time you think the indicator is peaked out, it starts to correct and then move on to new highs, stretching the elastic level. So right now we're at the previous high back in 2017, 2018. The Shiller PE was at a level only seen, it's just slightly above the 1929 level, which is not included in the chart. But the only other time it had been higher was at the height of the tech boom in the last year or so of the 18 months of the tech rally. So it was at a pretty high level. And that's what I was mentioning. There's 2 points. One is the level, and then the other is the trend in psychology. And it's possible to sometimes construct trend lines on the PE, and when the trend lines get violated, you can see that there's a significant reversal in trend. In fact, a reversal that amounts to many years. Because remember, this chart goes back to 1967. So each time you can draw a trend line that gets violated, then you get a major trend reversal, not only in the PE and the psychology of the whole thing, but also in terms of the market. The other point to bear in mind is that we look at trend lines to identify trends in the PE, but we also use the 48-month moving average. That's this moving average here. And when it's above the moving average, we get a green highlight. When it's below, we get a red highlight. So what we have in the current situation is we've got a break in the trend line, and we're still above the 48-month moving average. So there's a possibility we could ratchet this psychology up even higher than it's been in this current cycle, which will be a bit of a stretch. But it could, in markets, things that you don't expect to happen often do. So again, it goes back to this idea that we're at a critical point here, where the balance between the bullish factors and the bearish factors is fairly evenly balanced. One other factor is that the inflation-adjusted S&P composite is also below this trend line here and has rallied back to the extended trend line. So here again, we're at resistance, and we're in a situation where we're going to have to watch how things pan out here, because it's not a great idea to try and make strong predictions when you've got so much conflicting energy, so much conflicting evidence, I should say. So I mentioned about the economy before, and when we go back and we look at some of the bear markets in history, the bigger ones are all associated with recessions. So this chart and the next chart are kind of trying to get at the idea of whether we're entering a recession or not. The blue line they both represent price oscillators. The blue line represents a price oscillator of the GDP, where we divide a 3-month moving average by an 18-month moving average. And anyone who's studied GDP will notice that it only comes out once a quarter. So how do we get monthly data? Well, we just keep the same level each 3 months, and then when new data comes out, as it did last week, we add the new data in for the next 3 months and so forth. It's not a perfect way of doing it, but it allows us to get GDP plotted on the monthly charts, where it's only reported on a quarterly basis. And underneath is our Pring-Turner leading economic indicator. And this one here calculates the growth path for 4 sectors of the economy: housing, consumer spending, which is about 2/3 of the economy, employment, and the S&P composite. And when it crosses below 0, that's usually a time when it's sort of indicating the probabilities of a recession have increased quite a bit. Because you can see here, these red vertical lines indicate the approximate start of a recession. So here's the recession beginning, and we're crossing below zero. Same thing over here, same thing over here, and same thing just there. Sometimes it's a little late when it crosses zero, as it was in 1960. But generally speaking, when it starts to approach zero, one should get concerned that we may be approaching recession territory. A couple of caveats here. First of all, two of the components, real retail sales and housing starts, have only been reported up to January. We don't have the February data, which we would normally have because of the government shutdown. So it's only half of the indicators are in the formula at this point. So what we do is you just plot them as if they were unchanged in February. Another point is that approaching zero and crossing below it are two different things. And you can see with these three orange arrows that it's come down, the indicator has come down to zero 3 times in the past and bounced off. So just because it's at zero doesn't mean to say it's going to go through. And even when it goes through, like in 1966, we didn't actually fall into recession. But most of the times when that happens, the economy does fall into recession. And one other point is that in the last recession, it fell below zero, but it took about 6 months before it went bearish enough to cause a recession. So these are all caveats. Well, it looks like we're imminently going to fall into a recession based on most of these crossover points. This is only one indicator, and there are others that are saying a recession is much further down the road. One of those which isn't is this indicator here, which I showed. I think I showed it last month. It's the chemical activity barometer. It's a comprehensive leading economic indicator put out by the American Chemistry Council. I like it because it goes back to 1912. It's led every recession since 1912 by between 2 and 14 months with an average of 7. And it has different components in it than most other leading indicators. It has a lot of, although it's broadly based, it also includes a lot of different flows in chemical activity because the chemicals appear fairly early along in the supply chain, and that's what allows them changes in the activity to for the indicator itself to turn ahead of recessions and ahead of recoveries. Well, what we're looking at here is, again, another price oscillator, 3 months divided by 24 months. And you can see once again that this indicator also is approaching the zero line. And when it crosses below zero, historically, it's had a pretty consistent record of identifying recessions. You can see all the way through here, that was a little bit late. So when it gets down to zero, towards zero, it is warning that the economy might be softening enough to be sufficiently weak to be consistent with a recession. So the vertical lines once again start to show the start of recessions, and the recessions themselves are highlighted in red. And as you can see, as I said before, we're getting pretty close. But once again, there's been many situations in the past where we've got close and it hasn't gone into a recession. And look how close it got in 1966, where the Pring leading indicator gave us a false impression of weakness. This indicator turned around right at the zero level. So all I'm saying here is that both these indicators are getting close to offering a warning point, whereas when you read a lot of economic forecasts that are going, they're saying, well, we're at least a year away from recession. I'm saying with these indicators, we're not in recession yet, but to be careful, because if we get any further deterioration in them, they could be warning us of a problem. So what I'm going to do now is take a look at the KST for the S&P composite. And if we're approaching a bottom in the market or a top in the market, we would probably see the KST of the various sectors of the market moving in sympathy with what the S&P is doing. So in other words, what I'm going to do is I'm going to take a look at a bottom here in 2003, and you can see the KST, in this case here for the S&P composite, it's just started to turn up from below zero, and it's in a position where it can support a nice, strong rally. Whereas over here, for example, which we'll look at a little bit later, we're in a situation where it starts to cross below the moving average and suggests that the S&P is moving lower. So what I'm going to do now is take a look at a diagram of where the various sectors stand or stood in March or so of 2003, which is where this vertical line is, right at the bottom of this 2000-2002 bear market. So here's the theoretical curve which represents the long-term KST. And as we saw in the previous chart, the S&P, I'm sorry, we're also going to show you various sectors as well, where they stand with their KST. So red arrows indicate early cycle leaders. These will be sectors that tend to move ahead of the rest of the market. If you think of the S&P as a coincident indicator of the market, there are some sectors like utilities and REITs and things that tend to move ahead of the coincident indicator, which is the S&P, either in absolute terms or relative terms. And then there's also a set that tends to move after the S&P, late cycle leaders, resource-based stocks, and so forth. So we're going to try and get a picture of where we stood in March of 2003. And then we'll do it for the peak in 2007, and then we'll do it for where we were at the end of February, which is, of course, what we're most interested in. So here's the diagram for the S&P, and you can see that it was below zero and starting to turn up, as we saw in the previous chart. So now we're looking at where the leading sectors were. And as you can see, the bulk of them are either leading the market higher with rising momentum or even positive momentum above zero with the home builders, which tend to be an early cycle leader because they're very interest sensitive, and housing starts are the first things that actually move in the economy. So home builders are represented as an early group in the stock market cycle. And then the rest of them, brokers, consumer discretionary, transports, and so forth, are all in a position where their KSTs are still declining, but the next thing that's going to happen when they stop declining is the momentum going to start to rally, and maybe they rally themselves. So that's where all the leading sectors were, and this is where the lagging sectors were. Now these are only proximate positions, because you can see things get pretty crowded down here. So I'm just giving you a kind of a framework for what's going on. And just because you're a leading sector doesn't mean to say that you lead in every cycle or you lag in every cycle. It depends on the character of the cycle. But these are kind of general tendencies to say that in most cycles you'll find that home builders lead, and in most cycles you'll find that telecom leads, and in most cycles you'll things like semiconductors or oil and gas lag. But as you can see, basically speaking, all these sectors were positioned in a position where they could rally and support a bull market. So now we're looking at the top in 2008, and so you can see the S&P this time, instead of being below zero and rising, is now well above zero, well, moderately above zero and falling. So let's take a look and see what the framework was doing, telling us that. So once again, there's our theoretical KSTs. We're going to put in the early cycle and the late cycle leaders. There's the S&P up there, and there's the leading sectors. And because you expect the leading sectors to lead the S&P, this is where they were on the cycle. Home builders once again leading, because this was 2007. We were just about to have a bit of a problem in the housing area, and the home builders have more than moved ahead to discount those problems. And then we see the other leading groups are also well advanced in their decline above zero here, and others sort of just about ready to turn. And then we look at the lagging sectors, and we see that most of those were in a weak position, apart from the semiconductors. As I was saying, you know, that you expect the semis to be up here, but it doesn't happen in every cycle. Sometimes they move out of kilter because of individual structural problems or what have you for that particular cycle. So,
Martin, on that one with the oil and gas, so this is December, and then we know that oil topped in whatever June of 2008, and so there was a bit of a down cycle, and then they went on one kind of final surge. Do you see that happens where some industry really kind of, is just very odd for one of the cycles, or is that just kind of an anomaly for that particular one?
No, I don't think so, Greg. Quite often you find the momentum is going to turn ahead of the price. And that was the top of a very, very powerful move. So it's not surprising that the momentum started to turn down ahead of the actual prices. But you can certainly appreciate, I think, the fact that these sectors are in a totally different position than they were at the bottom in 2003. They were before all down here with lots of potential to go higher. And now they're in some kind of a corrective phase, or just about to go into a corrective phase.
Agreed. And so well, okay, I'll let you keep going here on this. Yeah.
No, you have questions.
Well, the only thing I was going to mention was the home builders cycled down pretty hard in 07 and 03, but in 07 particularly because we ended up, imploding the home building industry for a period of time there. And then, recently we've had an upturn on the home builders. The one thing that I would say is that, I've been trying to follow what the home builders are doing, what the broker dealers are doing on the most recent rally. And here, this is a great example where the broker dealers were still on their long-term momentum position, was declining in 2007. And, most recently, we still continue to see the broker dealers. I think they're even below their 200-day moving average and that kind of stuff still, if I'm not mistaken. I'm just going to look it up here.
Yeah, I think they're right at it.
Yeah.
The other thing, now you brought the home builders up, is, we had a bit of a financial crisis in 2008, 2009, and look how well advanced the financials were along with the home builders. The market's really kind of telling you, if you're going to have a problem in the bear market, this is the place to look for the most extreme ones in housing and in the banking sector.
Yeah, the broker dealers are right at the 200-day. Yeah.
So now we look at our third and most interesting period. We looked at the bottom, we looked at the top, and now we look at this period here where the S&P is falling and still some way above zero. It's more akin to where we were in 2007 than anything else. But we're not quite at 2007, as we'll see. So what we're going to do now is going to show you where bonds were, or where I should say where bonds are. And you can see before that our leading indicators have started to come down. At this point, just kind of flashing a slowdown. But bonds are positioned to experience a cyclical rally in price at this point here. So that's encouraging. And the S&P, as we saw in the previous chart, is kind of a little bit down on the bell curve, not as low as I'd like to see it, but just because it's coming down on the bell curve doesn't mean to say the S&P is declining. It could be doing this as it's experienced a trading range as we take out the really high numbers up here and put in some lower numbers down here. So that's that. And finally, one interesting observation here is that normally industrial commodities will be expected to be up here or over here. In other words, we would expect to see bonds lead stocks, lead commodities. And in this case here, commodities are falling in the middle of the peak for stocks and the bottom in bonds here, which is very, very unusual. And it reflects, I think, a very deflationary environment generally around the globe because of the big debt overhang that we've built up, which tends to because we borrow from the future, it tends to lessen our growth path when we have a huge debt load. So that's my sort of explanation of why commodities are leading stocks on the downside, is because of a deflationary, overall deflationary environment. So now we're going to put up the early cycle leaders and the late cycle leaders. So let's start with the early cycles. And here you can see that you've actually got a couple, utilities and REITs, above zero and rising. And then you've got a couple more following up with staples and telecom. And then a number of early cycle leaders are still correcting the excesses of the previous bull move that we had. So now we look at the late cycle leaders, and we see they're also for the most part, in a corrective mode, except for gold shares. And gold shares look fairly promising at this point because they're below zero and rising. So when we look at the way things are constructed, we've got bonds in a positive position, and interest-sensitive utilities and REITs and defensive staples and interest-sensitive telecom all confirming what the bond market's telling us, and that is that they're in the early cycle stage of recovery. And yet, on the other hand, we've got a lot of sectors and industry groups that are still in a corrective mode here, which kind of suggests to me that we're in a position where we've already formed a foundation to go higher, but we need to get all these other sectors to correct. Alternatively, what they could do instead of correcting is they can do what semiconductors have just done, where they've come down from high level and then started to turn up again. So that's another possibility that we could see, is a lot of these groups start to turn up here. But until they do, we have to assume that they're still in this corrective mode, and that's going to act as a drag on the market. So once again, we're getting a conflicting picture here. We're not getting a fully bullish picture. We're not getting a fully bearish picture, but we're getting a slightly bearish picture because in terms of weight on the indexes, we don't have a lot of weight over here saying that things are going higher, and we have a greater weight here saying that they're either going to correct or go lower or experience a sideways correction. So that's where I see it right now, Greg.
I agree. And one of the questions that seems to keep coming up is the commodities can't get out of their own way, which is the one that surprises me the most. But, industrial commodities have tried to rally briefly here. Oil and gas is still very, very low. They just don't seem to be able to rally at all. And I'm, very hesitant to try and figure out, on the bigger cycle, they're starting to turn. I'll call it on the weekly cycle. But, they're still, in terms of a long-term momentum, they don't look great, that's for sure.
Yeah, and that again is backed up by where the industrial commodities are. They're down here, and they should be somewhere up here or up here.
Yeah.
The cycle, and they're not. So again, I keep going back to the fact I think it reflects the debt overhang and the overall deflationary environment that we've got. So we'll take a look at commodities a little bit later, though.
Okay, go ahead.
Right now, I wanted to look at a more optimistic chart. This is the Shanghai Composite, and it goes back to 1994 or so. And the index broke below this secular uptrend line last year. And to me, that was a really bearish signal because that's a long-term trend. And when you get going back to 1995, that's a 20-year line or so forth, 25-year. That's a pretty important trend break. But look what's happened in the last couple of months or so. It's broken below, it went decisively below the trend line, and now it's rallied back above the trend line and back decisively above its 12-month moving average. And notice also that the moving average and the trend line are in the same vicinity, which kind of increases their importance as a resistance area. And now they're both in the same area, and if it came down, that would be in terms of support. What's missing is some rallying momentum here because the long-term KST is fairly flat here. It's a little bit bearish, but it's fairly flat. But I think it's going to turn, and I've got a couple of reasons why I think that's going to happen. First of all, if you put a Coppock indicator underneath instead of the KST, the Coppock's a little bit more sensitive than the KST, and usually when the Coppock turns, the KST will follow. And so what I've done is I put the arrows here. Solid arrows represent signals when the Coppock indicator turned up, and it turned out to be followed by a nice rally, and the dashed lines indicate failures. I mean, here's the Coppock turning up, and you can't really call that a successful rally. Didn't get above its 12-month moving average, for example. But right now, the Coppock has started to turn up, giving us another buy signal, and we are above the 12-month moving average, so that's a positive sign too. And the fact that it's managed to rally back above this secular trend line, because before it was support, and it was a very important level of support because it's been touched 1, 2, 3, approached 4, 5, 6 times. So now it reverses that role to it was support, and now then became resistance. So moving above it but on a resistance basis was equally as important as dropping below as support. So it's now above, which is very important. So the other reason I'm fairly confident about the market rallying above, the Chinese market rallying above this very important downtrend line is this next chart here. And this is, again, the Shanghai Composite at the top. And underneath is a diffusion indicator, which I developed, which monitors a basket of Chinese stocks that are above their 40-week moving average. So when they're all above their 40-week moving average, you get a high reading, and when most of them are below, we get a low reading. And when it crosses the 15-week moving average, which is this red moving average here, that gives us a green highlight on the chart. And as you can see, once you get a green highlight or red highlight when it goes below, they tend to last for a fairly long period of time. Sometimes they just might last a very short period, but the vast majority, like during this bear market, it went bearish. And then in the end of February, it went bullish again. And not only did it go bullish, but it went bullish from a low level. And although we've had a couple of reversals from a low level, which haven't amounted to much, those two there, I mean, it was a rally, but not a serious rally, neither was that one there. Most of those bull market, or those oversold readings when they reversed, have given us a pretty good rally in China. And that, I think, is going to be sufficient, based on its previous record, to give us enough of a launching pad to get through this green downtrend line, turning the Chinese market totally positive. So I think that's a obviously bullish sign for, if you believe markets are connected to the economy, then that's a bullish sign for the Chinese economy down the road, which is since they're number 2 in the world, it's a bullish sign for a bullish factor for the global economy as well. So now I'm going to move over to the StockCharts platform. So now we're looking at the Dow Jones Global Index for equities, and as you can see, we've got a lot of different trend lines that have been broken and other things that are going on here. But basically, this chart is offering us a bit of a mixed message when it tends to lean to the bearish side, more bearish than for the US. First of all, we still got the declining peaks and troughs. There's a peak, trough, and they're still declining. Troughs are lower and peaks are lower. So that's one negative. Second of all, our KST, a long-term KST, is still bearish. And it's also below the extended secular uptrend line, this blue line here, which is unfortunate. So the bulk of the evidence is still pointing to the bearish side, although the 12-month moving average I've got as neutral. It's actually, technically speaking, it's positive because moving average is at 387 and the last plot's at 389. So it's technically bullish, but because the moving average and the trend line are both or the extended trend line and the moving average are in the same area, we really need to overcome that resistance in a more decisive basis before we could say that the 12-month moving average was positive. And then the other thing about the chart is the KST is now crossing this red line, and that's what's happened you can see what happened in the past. Is if you're in a bear market, there's further to come, and if you're in a consolidation or a bull market, usually what happens is that you get a rally and then you get some sideways action, as you had in 2011, 2012, and then 2014, 2016, the same sort of thing, where you needed to recover. And that's, if you go back to our diagram of where the KSTs for the various sectors were, you can appreciate that probably we need some time where we get some trading range action before we can move higher, if that is in fact the direction in which it's going. So I'm going to put it in the view mode now so I can move on to the next charts on the chart list here. Now we're looking at the US, the New York Stock Exchange Composite, the NYA, and underneath is a special K indicator, which for those of you who aren't familiar with it, what we do is we add up the short-term momentum, the intermediate momentum, and the long-term momentum into one overall indicator, so that when the indicator peaks, it tends to peak along with the price that it's monitoring, and when it troughs, it tends to trough along with the price it's monitoring. And it does that about 70% of the time, and some of the time it doesn't. Like over here, here's the bottom, and then there's the clear cut bottom in the indicator. So most of the time it will. So our problem then is not identifying where the peaks and troughs were when the benefit of hindsight. We're going to be in real time. So what we do is we look at when the indicator crosses above or below the signal line, which is what these arrows are pointing up. There's a signal line just there. That gives us an approximate signal. And then another thing is we look at the trend line violations when they take place as well. So fast forwarding to the NYA, you can see, first of all, it's been in a bear market for 1 year, and it's now back above the 12-month moving, the 200-day moving average. And if you take the average of some of the major bull markets that have occurred since the 1970s, you find the average is something like 17 months or something. So based on that, we're 13 months into this since the peak. So we may well be towards the end of this corrective process. But what we do need to see with the NYA is for it to break above these two trend lines. And once again, you've got a nice trend line here, which it broke below, and we got a drop, and it's still below that trend line, and it's still below the extended trend line. And it's also below the what we might call the bear market trend line, which joins the high with the first rally high. And those lines are both in the same vicinity. So that means that they represent very, very significant barriers of resistance. And at the same time, you've got the a sell signal from the special K, not only with this uptrend line violation, but it also completed a top. And that remains in force until the special K can cross above its signal line, which again is intersecting with this trend line. So that's a very important level around 155. And again, to me, it suggests that maybe what we're going to have to do is come back down and rally back up and come back down, and then eventually get above this resistance. But it seems like to me like a pretty tall stretch to expect the special K to go straight up through the line without any kind of correction, because that would be an extraordinarily powerful move. I mentioned before that one of the indicators, the momentum indicators I'm following, apart from the 12-month rate of change, is super bullish. And this one here, this is a 45-day rate of change for the S&P. And this blue line represents the point where the 45-day rate of change got to on Friday, which March the 1st. And you can see that every time it's got up to that level, we get and gone through, we get or not gone through, but either got up or gone through. We get a green arrow here. And each time we get a green arrow, what happens to the market? It moves substantially higher. Only once did we reach this line, and that was in the bear market 2000, 2002. And it occurred after the oversold reading of the 9/11 raid. And that turned out to be a bear market rally. But every other rally that we've had and reached this level here has been a bull market rally, and it's represented a rally coming off a major low. So looking at our evidence, we've got a lot of negative evidence, but we got some positive evidence as well. So that's why I say it's fairly evenly balanced at this point. I'm going to move on a little bit here onto bonds now. And here's the 10-year yield. And just to put it in perspective, this goes back to 1983 at this peak here. We've got the secular bear market taking place where the yields zigzag up and down, but on a downward basis over a secular trend, which lasted for, or has lasted for about 30, 35 years. Got up to the line, got a false breakout above it, and now we're back below the 12-month moving average again. And also the oscillator, the KST, is also bearish and still at a fairly overbought level. So what that suggests to me is that eventually I think we're going to be breaking through this green downtrend line here, and that will be the signal for a secular reversal. But in the meantime, when you look at previous secular reversals of interest rates going back over the last 150 years or so, you see that they've usually experienced some kind of a trading range or ranging action, just like what we've seen here. And so I think we're going to see a little bit of an extension to that ranging action with an eventual breakout to the upside. So couple of reasons why I think that's so. First, a false breakout here. Second of all, the high reading in the KST. And also, I should point out the fact that the KST has reached a higher level than it's reached during the course of this secular bull market or this secular bear market suggests to me that there's really powerful upside momentum here that is eventually going to take hold and represents in itself a characteristic of a secular bull market in rates. But in the meantime, it seems to me that we're going to experience some corrective activity. So here's the 10-year yield again. Now we're looking at a more recent chart going from the last 5 years or so. You can see that uptrend that we saw in the previous chart has been violated. The yield also broke down from a broadening wedge. The wedge is the idea that it's kind of like a reverse triangle, where a triangle, the two marking lines converge. With the broadening wedge, they diverge, and that indicates a widening battle between buyers and sellers as we get more volatility, and the wedge tends to be followed by an above average decline. What's happened so far, though, is that we saw a decline, and yet there's been no follow through. What I would expect after this little rally here back to the 65-day exponential moving average, I would expect a drop and to significant new lows, but we didn't get that. We got a successful test, and now we're coming back to test the high. So I think we're in a kind of a no man's land here that could be followed by lower yields or higher yields, and the momentum in the bottom panel is kind of mixed. And since bond yields tend to move or be driven by what happens in the commodity markets, let's take a closer look now and see what commodities are doing. So here is the CRB composite in the upper panels, the monthly chart going back to 1994. And underneath is my Pring inflation-deflation ratio. You can plot this on StockCharts very easily using the exclamation mark PRII, which represents the Pring inflation index. And that index consists of S&P groups that are resource-based and tend to do better when commodities are moving on the upside. And then that's compared to the PRDI, which is the Pring deflation index, which takes stocks or sectors from the other side of the cycle that tend to be sensitive to interest rate moves. Basically, what I'm trying to show here is that the stock market, in betting for inflation versus deflation sensitive stocks, is basically telling you what's likely to happen in the commodity markets, because these green arrows here and red arrows represent the fact that the turning points in the inflation-deflation ratio, what the stock market's saying, have a tendency, it doesn't happen in every situation, but has a tendency to move ahead of what's going in the actual commodity markets. And as you can see here, the inflation-deflation ratio is essentially in a trading range, or has been since 2016, but with a bit of a downward bias, and that sort of hints that maybe commodity prices are going to come down. And whereas the commodity prices themselves have been going more of a sideways trading range. There's one point on the upside I would look at. Right now, I think we're in a bearish trend for commodities because we're below the moving average, and the KST for the ratio, this KST is for that ratio, is in a declining trend as well. So I think the balance of evidence is pointing to the downside for commodities, but it's not unequivocal at this point. It's fairly evenly balanced. But in order to turn bullish, we need to see the inflation-deflation ratio move above this green downtrend line. And we would need to see the CRB composite move above this downtrend line here decisively, and that would be probably a month-end close above 200. Next chart shows just the inflation-deflation ratio on a daily basis with a special K. And here you can really see the fine balance that's going on. Remember, this indicator moves up and down with commodity prices, and it's stuck in a really tight trading range here with a slightly bearish bias, of course, because it's below its 200-day moving average here. But again, it kind of reflects the very tight balance between what's going on in commodity prices. And you see the same thing here with this inflation-deflation relationship. The commodity, the CRB divided by bonds. When it's going up, it means it's inflationary because the CRB is beating bonds and vice versa. That ratio also is in a trading range, but with a downward bias because it's below its 200-day moving average. It's below this uptrend line here. And the special K for this ratio is also below this uptrend line, and it completed at the top. It's also below its signal line, I should say. The last few weeks, it's gone more to a neutral range, but overall, I think the chart has a deflationary or negative tone to it. In other words, it suggests that we may well break down to the downside. But I'm not going to second guess what the market's going to do. I'm going to watch this fairly carefully. And I'm also going to watch this chart here, which is going to just show you the CRB itself. And you can see how this is a daily chart, how finely balanced it is, really on even a very, very short-term basis. Because the CRB is just poised right above this uptrend line, as is the 9-day RSI. Any further weakness, and it starts to break below. The other thing we're going to look at finally is the CRB relative to the Canadian dollar, which I mentioned first of all in my opening remarks. So here's the CRB in the upper panel, the Canadian dollar in the lower panel. I won't say they're a mirror image of each other, but they do move on a long-term basis in a fairly similar direction. And so I think the Australian dollar, which we'll look at a little later, bear to need watching here. And the Canadian dollar is below its 12-month moving average, and its long-term KST is in a bearish mode, but it's not decisive. I mean, you get a bit of a rally here, and you can change what's going on. And let's take a closer look at a more near-term chart for the Canadian dollar. And here we see the Canadian dollar on a daily closing basis, together with its special K. And again, they're both in downtrends, but it wouldn't take much to reverse them to the upside. And then finally, we got another short-term chart of the Canadian dollar using Friday's close. And here you can see that it may well be forming some kind of a head and shoulders top. Interestingly, bound on the upside by the 200-day moving average and on the downside by the 50-day moving average. Really interesting technical phenomena that. So very big resistance at 76.25 and very big support just a little bit below 75.20, say 75 cents. We also see the KST is in a downward trajectory and the RSI is broken below this trend line. So on balance, we're kind of tipping to the downside. But until the Canadian dollar breaks below the 75-cent level, we have to assume it's in that neutral trend. And then I think the final chart I'm going to show you today is the CRB composite. Again, with the Australian dollar, again, I'm just trying to emphasize the connection between commodities and the currencies, which in this case, if we're watching the currency and we're watching the commodity and they both break to the upside or both break to the downside, they're reinforcing each other and giving us that stronger signal. And we're always, as I said right at the beginning of the presentation, we're interested in probabilities. And the more things are pointing in the same direction, the greater the probability that move is going to be a valid one. So, Greg, I've left you a few minutes for questions. I apologize for not leaving longer, but let's get to them.
Well, one of the things I noticed this week on the CRB composite was it's rolling over right at its 20-week moving average after that big move down into the January low. And that is just really technically not great. Yeah, that chart there would have it. So your CRB index, that is daily, but this rollover right here at this 184, 182 level is pretty important. It's roughly the 20-week moving average. I think the 20-week is right around 184, or sorry, 183, and it rolled over. And the concern I have, of course, is as you can see on the chart, there are a series of lower highs and lower lows, and any rollover here kind of at that 20-week mark is not really what we want to see from that whole group. And the fact that gold let go so hard and the Japanese yen dropped this week just kind of points lower for commodities in general. Not very happy with the correlation.
Well, the other thing is if you look at recessionary period, well, if you look at slowdown, growth slowdowns, commodities, not every slowdown since 1966, but in most slowdowns, I forget, I think it was 6 out of 8 or something like that. Commodity prices ended the slowdown at a lower level than when they started. When you look at recessions, they're all, well, I won't say they always, because you can never say that, but since I think it was the 1960s, every recession has been followed by, has been associated with lower commodity prices. So this commodity has also become an economic indicator because they're kind of mark to market. The
I
other,
I agree. I think commodities are a very good economic indicator. Yeah.
yeah. So that's again a reason for watching what happens in these commodity markets to see or not whether we get that weakness. If we get the weakness like we had in 2014, that's indicative of a weaker economy.
Well, and the real, like copper kind of spiked on its own this week. Didn't see a whole bunch of response across the group, the industrial metals group, but steel is right up, the SLX ETF is right up against a horizontal support and resistance level. Um, the
So
copper the copper chart was okay, but the rollover in gold and silver was pretty extreme, and yeah, so you can just see. I don't know if you can get to your weekly chart, but um, that 41 level is pretty important on the silver chart there.
yeah, this is the that's the weekly or the weekly KST, the relative strength against the S&P, and the relative strength KST.
Yeah, so they're all breaking lower, but that 41 level is pretty much, looking back to the left there, 2012, 13, 14 for the steel ETF has been a pretty important place, and even for the topping pattern in 2018, early
Well, look, it
2018,
just
we're
got
all at
up to,
41
sorry,
level. Yeah.
sorry, I didn't mean to interrupt. I was just pointing out it got up to its 65-week exponential and the week before last, and then it looked like it backed off slightly last week.
Yeah, so they're just really at an important point here. Obviously, I'd like to go bullish on commodities because there's just so many of them, but um, they've all had a nice kind of pop, and then like the gold ones were just really that was kind of a harsh reversal this week in the price of gold. I think it was on Thursday or whatever, and gold ended up closing down on the month. For February, it actually closed $10 lower on the month.
Yeah, I had a couple of gold charts I was going to show, but I, as usual, ran my mouth and we didn't have time for it.
Well, that's all right. We're pretty close to running out of time. Hey, Martin, thanks again for taking the time to put this all together for us. Lots of great charts in there. I couldn't agree more that we're, very finely balanced here as to whether or not the market's got enough strength to continue higher. But thank you for taking the time. We will talk to you again in the April market roundup. Thank you.
Thanks, everybody. Thanks, Craig.
This is a little info demo to show you how to put a solid line or something like that on the top of an indicator that you might already have. When you scroll down here, it was on the SCTR line, but I want an overlay of a horizontal line. And in this case, I can set it up so I put the line at 75 for on the indicator SCTR, and using the colon symbol and then the word blue, it'll put a blue line up there for me like this. So if you're looking to do overlays, just those simple little tools, but use the colon command to help color it.